If you think 6% mortgage rates are going to fix the housing market, you're about to get blindsided. The National Association of Realtors says 2026 is the comeback year, but they left out the one cost that's exploding faster than interest. The National Association of Realtors just released their 2026 housing forecast. And before we go any further, buckle up, because this is going to be a little bit dense, but it matters because almost nobody is talking about the pieces that actually determine whether this year is going to be a rebound or just a reality check. And while I think some of NAR's optimism is justified, there are a few massive variables in their forecast that they didn't include, and those blind spots could change the entire story. So NAR's headline is simple. Once mortgage rates hit 6%, the market unlocks. Sellers finally let go of their low-rate homes, buyers come flooding back, and they're calling for a 14% jump in home sales. That's the housing comeback. But here's where the divergence hits. The institutions that model the market based on risk, debt stress, and solvency, Fannie Mae and the MBA, are way more cautious. They're projecting barely any price growth and a much slower recovery because the affordability crisis isn't about interest rates anymore. It's structural. And this is where NAR's forecast glosses over the real pressure points. You see, insurance is exploding, not a little annual bump. I'm talking massive actuarial resets. Carriers leaving states, wildfire risk, repricing entire neighborhoods, fair plans stepping in as the last resort insurer, and those policies can double or triple a buyer's monthly costs. And when that insurance line item jumps by $200 or $300 a month, it erases every bit of savings you'd gain from rates dropping into the sixes. Then layer on local structural stress. So especially here in Colorado Springs, the 300-year water rule pushing development costs higher, wildfire zones tightening underwriting, a local economy tied to federal budgets and deployment cycles. These aren't national trends, but these are the microeconomic forces that completely change how our market responds compared to what those broad national forecasts are assuming. So yes, lower rates do help, but they don't magically unwind 5 years of inflation, insurance volatility, stagnant wages, and structural costs that have quietly rewritten what affordable even means. That's why this isn't about predicting a boom or calling for a crash. We're talking about understanding the mechanics of the market and how they've changed and making decisions with variables that actually move the needle, not just the headline. And for the record, if you are thinking about buying or selling or investing anywhere in the country, follow along because the people who understand these shifts now are the ones who make the smartest moves next year. I'm Petitt, and I keep track of everything Colorado Springs and real estate so you don't have to.